Coming up on the SBS On the Money podcast, China's economy expands more than expected. Is a mega copper merger on the cards? And we take a look at opportunities for investors in the market right now. That's all next. Hi everyone, it's your daily 10-minute business and finance news wrap for this Friday, the 17th of January 2025. The Australian share market fell today. We'll have the details with Dianne Colledge from Morgans, including opportunities for investors at the moment. But first, we'll start with China because its economy expanded by 5.4% in the fourth quarter compared with a year earlier. That means for the year, GDP expanded by 5% in 2024, more than expected, and right on the government's target. Its economy has failed to return to pre-COVID levels following a property crisis, which has eroded consumer confidence in spending. But a flurry of recent stimulus measures, which have boosted manufacturing activity and exports, has provided some support. So for more details, I spoke with Gerard Burg, International Senior Economist at NAB.
First of all, I think it's worth noting that this required a pretty significant upward revision to its quarterly growth numbers for both Q2 and Q3. Going into this quarter, we sort of suggested that the target was probably out of reach, would have needed a very strong acceleration in Q4, but that revision sort of brought that target much closer to what was doable in terms of that result. The other thing that I sort of stress about this situation is that there's still a fundamental imbalance within China's economy at present. So we've got between supply and demand side of the economy, and that's led to the real surge in exports that we've seen over the last 2 years or so now, driving a record high trade surplus and obviously the trade tensions with the United States. So within the backdrop of, yes, they've hit the target, but there are a lot of challenges still there sitting in China's economy.
Given that the headline number is good, can it be sustained? We're talking about a lot of headwinds to come. Can it be sustained? I know that the World Bank overnight said that China's economy is expected to slow to 4% in 2026, very much below its 5% that it hit just now. What do you think?
Yeah, we also see a slowing trend, not necessarily quite as large. We see growth in 2026 at about 4.4%. But as you note, there's those significant headwinds of the growing trade tensions and the prospect of the tariffs being introduced by the Trump administration. That should have a pretty significant impact. There's still a fundamental weakness in terms of domestic demand China really needs to address. So the question is, can China's government implement fiscal stimulus that can meaningfully address that weakness?
So what is the feeling there? Do you expect the Chinese policymakers to be injecting extra stimulus to keep China bubbling along? And what do you think this will mean for Australia?
We do expect to see some form of stimulus. The question is, it's not so much even the size of the stimulus, it's where it's directed. And, historically, there seems to be an ideological barrier to really implementing demand-side policies that will sort of boost household incomes and therefore directly boost demand. That's what we'd really like to see happen. Whether that can finally change in 2025 or 2026, really remains to be seen. From an Australian perspective, the real challenge is the potential for slower growth over these coming years to really meaningfully impact demand for commodities. And so we'd expect to see that primarily come through prices for commodities flowing into corporate profits and household wealth, and therefore impacting our economy through those kind of channels. As a rough guide, the Treasury usually suggests that a $10 drop in the iron ore price roughly equates to about $500 million to the budget bottom line. So that's one of the areas that we're really watching for an impact directly to Australia.
That's Gerard Burg there from NAB. Now, Market Day on the SBS On the Money podcast. The Australian share market ending the week on a soft note. The S&P ASX 200 down 0.2% to 8,310. For more, I spoke with Dianne Colledge, a private client advisor at Morgans. Dianne, on the market, it's a relatively quiet day today, but looking ahead, what do you think will be driving the market? Because in the weeks ahead, we've got Donald Trump's inauguration, the potential fallout there, interest rate decisions around the world, and we've also got corporate reporting season.
Yeah, great question, Ricardo. Good afternoon. I think our markets will probably be moved primarily around the corporate reporting season, and that's starting in the US this week. And we've seen some really solid results out of the banks, particularly Wells Fargo, JP Morgan, and also Bank of America. Um, and going forward, next week, we've got bigger names such as Netflix, Tesla, ServiceNow, Procter & Gamble, and Johnson & Johnson. And these are all quite big bellwethers that sort of will dictate how the market sees the economy going forward. When we look at our reporting season, that starts in February, and we've already seen a couple of domestic retailers in particular come out and say that they've seen some slowing of sales. So that sort of points to a bit of a slowing economy here in Australia and a slower consumer, which is all important when it comes to interest rate decisions from the RBA. When you talk about some of the other things that are impacting markets in the next sort of 1 to 2 weeks, we do have interest rates being sort of connected very heavily towards inflation, as we know, and that's going to be an ongoing focus both here in Australia and also in the States. Yes, it's going to be very interesting to see what happens after January 20 in the inauguration. Markets will have a number of different choices for a direction, whether it be up, down, or sideways. So, unfortunately, we won't know what will happen until it happens.
Speaking of not knowing what will happen till it happens, will be those potential tariffs on China, right? With Donald Trump coming into power. But out of China today, GDP figures, I think it was 5.4% for the quarter year on year, and on target annually 5% for 2024. What does that say about its economy and the implications for Australia?
Yes, so those numbers are quite correct. Basically, the uh, quarterly numbers were quite strong for GDP and also retail sales. Unfortunately, we did see a decline, or an ongoing decline, if you like, for other sectors of the market, such as home sales, which were down about 17%, and also industrial production and manufacturing. They were down about 23% for the construction. What I did find incredibly interesting were the population data. So we saw that the birth rate was outnumbered by the death rate. And that means that we've got a bit of a negative impact for population growth going forward. However, the birth rate itself was quite strong compared to what it had been over the previous 3 years. And that saw one of our domestic companies, such as A2 Milk, perform quite positively on the back of that announcement. But with respect to the broader economy here in Australia, another lot of data that came out in these numbers was the export data for China, which reached an unprecedented $992 billion. And what we saw there was that a lot of those exports out of China have been brought forward prior to any type of Trump tariffs impacting their ability to export to the US. So, it's a mixed bag from the Australian point of view, because we're probably going to be negatively impacted by the drop in construction spending, but positively impacted by the fact that, they have still got a bit of time to actually get those exports out to the rest of the world and the US in particular.
Yeah, those population numbers were interesting, because I also read that while that birth rate rose, it could be temporary because there was a 12% increase in marriages in 2023. So it's just a delayed response in birth rates. Speaking of China as well, it's a big consumer of iron ore. We've got some news in the iron ore / copper space. Reports of a merger, discussions between Glencore and Rio Tinto. What do you know of this, and what's the appeal here?
Well, again, I think, these big global miners, M&A is a lot more attractive in the current market, with the fact that we've got a lot sort of lower commodity prices. Interestingly, Glencore made a proposed merger with Rio back in 2014. I'm not sure if you remember that. And that particularly was all around iron ore, but now it looks like it's about copper. So ultimately, we've seen BHP make an approach for Anglo America, and we may even see that being prompted again because of this sort of drive to secure these copper resources, because it's just an ability to generate further growth for the acquirer, whereby they can't actually go out and do it themselves. So if you can't do it yourself, you buy it. And that's what we're seeing at the moment.
And finally, as we start the new year, what are you telling your clients at the moment, or what are they asking you?
Interestingly, we're sort of going back and looking at our asset allocation across portfolios, and we sort of do have a bit of a positive view on global markets, primarily those smaller companies that are connected to the US and connected to the fact that once Trump does become the president, we should see a little bit more America great again type focus on their domestic smaller cap companies. So we're sort of thinking that clients should actually increase their exposure to that end of the market. And we're doing that via ETFs that are listed here in Australia, but access that part of the global market in the US. Domestically, I'm telling clients to actually just sit back and wait for a little while just to sort of see what our domestic reporting season delivers to the market. And then I think that will give us a bit more of a roadmap as to where we should start allocating funds from clients' portfolios.
That's Dianne Colledge there from Morgans.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.